Hey, what's going on, guys? It's Money Madu with YouGotPreapproved.com and MLS number 2246741. In this episode today, we're going to go into DSCR loans. Now, with these DSCR loans, I know you've heard about it a lot, how you don't have to put any income down or anything of that nature. I'm going to go into detail about what this loan is and how you can utilize it and increase your rental portfolio. So let's get right into it. All right, here are some DSCR highlights. So one major thing with DSCR, you do not have to provide W-2 documentation, which is very much a limitation when it comes to a lot of people who are self-employed and are wanting to purchase a home just either as a first-time home buyer or just a home just to live in. W-2 income when you're self-employed, it's a little bit harder to actually get approved for the amount that you want because most self-employed people write off a lot in taxes, meaning that because they do that, they're showing that they don't make a lot, and then the lender says, okay, well, technically you only make this much, you can only get approved for this much. So you don't have to provide W-2 documentation when it comes to DSCR loans. Another big benefit with the DSCR loan is that you can borrow as an entity. So if you have an LLC, S corp, incorporation, any kind of entity, you can close your home with a DSCR loan. Another thing too, it allows you to scale your rental portfolio. DSCR loans are really about the income that you're bringing in, and that's where you're able to really qualify for more houses. So if you know how to run numbers correctly, you can utilize DSCR loans to your benefit to scale your rental portfolio. There are refinancing options available if you're trying to cash out refinance. Most times, and I'll get into it later, if you are in a situation where you might have done a fix and flip and you need some kind of way, the house did not sell, so you need an opportunity to keep the property without paying more fees to your current hard money lender, you're going to have to refinance. And so if you need to do that, a DSCR loan is how you're going to be able to switch over to a normal 15-year, 30-year conventional loan. And the last of the highlights is less documentation is needed, right? So that is the DSCR highlights that I'll be talking more into with this episode. All right, so what is DSCR? So DSCR is debt service coverage ratio. Right. And so this is used to find a property's ability to cover its debt obligations. Now, what does this mean? So here we have a formula, right? And so the formula is the net operating income divided by the debt service. So just as a verification, I put down here net operating income is the property's income. So if you have a property that you're looking to buy, and let's just say that the landlord says that it's bringing in $2,000 a month, right? The debt service is the principal and the interest payment on the current home. So, for example, if the property is bringing in $2,000 a month, but the current mortgage on it is, let's just say, $1,500, right? So that is where you will find where your ratio is. So with this type of ratio, your debt service ratio would be a 1.3, which is really good. Most lenders, they would rather you have a 1.25 and above. Some lenders will go down to a 1-to-1 ratio. If it's under 1-to-1, then you start looking at different technicalities as far as like how much you would have to put down and such. But we'll get into that here in a bit. All right, so the interpretation of a DSCR ratio. So DSCR equals 1. That means it's a 1-to-1 ratio, right? So that means if the property brings in $2,000 and your mortgage payment is $2,000, that is a 1% ratio. Now, if the DSCR ratio is is greater than 1, like we had mentioned before, right? Then that means you are in a great ratio. Now, if it's a situation where it's under 1, then, maybe you're bringing in 2,000, but it's 2,200. Now you're looking at a 0.9% ratio. And that's under 1. So a lot of lender overlays deal with 1% and above. If it does allow you to rent for 1% or to purchase with a 1% under, there's usually a 5% hit on how much you have to put down. So the DSCR of a 1.25 or higher is often considered the standard requirement. But again, as long as you could get that thing around, as long as you can get that thing around 1, you're good. All right, so a little bit about myself. I am licensed in Texas if you're looking to purchase a home as a first-time home buyer. But if you are looking to purchase an investment property using, like, for example, a DSCR loan, I can help you in any state in the United States. My goal is to help you make the best choice in purchasing a home and give you the education needed so you can make the best purchase possible. So if you need to get in contact with me, you can reach out at yougotpreapproved.com, or you can shoot me an email at oge.madu@topchoicelending.net. All right, so going into down payment. So when we're talking about down payment for the DSCR loan, you are looking at a range between 15% and 35%, and it really just depends on your risk profile, right? And then another thing too is your credit score cannot be lower than a 620. And in all honesty, with a lot of lenders, they like this 620 to be about 660 and higher. But if your credit score is less than a 620, you're not going to be able to utilize the DSCR loan because it is a conventional loan that you're going into, and conventional guidelines say that they do not lend under 620. As far as closing costs go, these are the same as other loan types. So the FHAs, the VAs, the conventionals, the USDAs is exactly the same. You're also able to get seller's concessions or seller's credits pending a sales overlay, or I guess the amount that you're able to get is pending the sales overlay, but you are able to capitalize on seller's concessions if they are given to you by the seller. Now, some of the common closing costs that you will see is the loan origination fee, which is the loan officer's fee for doing the deal, survey fee if you don't have a survey already, recording fee, appraisal fee, title insurance. That's just some of the normal closing costs that you can expect to see with a DSCR loan. Hey, what's going on, guys? I wanted to jump in here really quickly and talk about these limitless focus supplements from Phoenix Athletica. I take 2 of these and go straight to work. These brain pills allow me to get these YouTube videos for you guys on time every single week, especially when I'm having trouble just focusing. These get me right on target. So they're running a special right now, buy 2, get 1 free when you use the code RISE. Let me know how you love them. All right, some quick pros and cons, right? So pros, again, you don't need W-2 income to qualify. You can close in an entity like an LLC. It gives you opportunity to get more rental income, right? And then there are flexible loan options. Now, some of the cons, you definitely are going to get a higher down payment. Now, if you're working with a FHA loan, a VA loan, things of that nature, it's your primary residence. So you're able to get a lower down payment because it's backed by the government. Because this is a little bit different where it's an investment property, your down payment is going to be higher. So it goes back to that 15 to 35% that I mentioned before. Interest rates tend to be higher with the DSCR loans, right? You cannot live in the property, and it's limited for non-income producing property. So if you don't have if you don't have rent coming in, then it's going to be hard to close on a property on a DSCR loan unless you're just bringing in more money. So that let's just say 75%, right? And that DSCR ratio is under 1, then that 75% now goes down to 70. And so that's a 30% down payment, right? So that's just some of the things that you have to kind of like keep in mind whenever you are looking to utilize a DSCR loan. All right, here are some of the property types that can be financed with a DSCR loan. Obviously, a single family home, condo or a townhouse, 2 to 4 units, or multifamily, triplex, quadplex. A retail center could work if you're going to go the commercial route with it. Same with hotels, mixed use developments. So it could be a situation where you have a property, a barbershop is in the bottom floor and you live on the top floor. That would be considered a mixed use development. a DSCR can be used to purchase that. And also a self-storage facility would be something that you could use as far as like a property type that would work under a DSCR loan. So refinances. So there's two main refinances. There is the rate and term, and then there's the cash out. So with rate and term, that pretty much means that you're not trying to pull out money out of the deal. You're just trying to get a normal loan, just go into your 30-year note without any issues. You're not trying to pull out any of your equity. Now, if there is equity in the home, then you might be looking to use a cash out refinance, right? And so the max loan values, it really just depends on the market that you're in, but it can go from 75% to 80%, right? And so it's kind of to go into it a little bit deeper, as an example, if you have a property, right, and it's currently worth $300,000, most lenders, especially if you're trying to do a cash out refinance, most lenders will not give you more than 75% of this value. And so 75% of this value is $225,000. And so what you have to hope that happens is your total all-in payoff amount with your current lender needs to be at least $210,000, because I'm trying to help you factor in closing costs, right? So you have to deal with closing costs and fees of that nature. So if your total payout is this much, then you would be able, and this is just to, in a sense, break even. You would preferably want this number to be as low as possible. If this number happens to be, if you're all in at 150, that would mean you could pull up to $75,000 out minus whatever closing costs. Let's just say, I don't know, $10,000 in closing. So let's just say $65,000 would be what you're looking at getting out in equity. So if you are in a situation where and you're looking to refinance, one of the things I really want you to understand, because I deal with these clients a lot, is a lot of it deals with the appraisal. The lender is going to go ask for an appraisal to be done. And so whatever value you think is in your head, it really doesn't matter until that appraisal comes back. So if you in your head think that this house was worth $350, but the appraisal comes back at $300, the lender is going to go based off of that $300 number. And then on top of that, you want your payoff amount to be a lot lower. And so again, we're going based off of 75%. If you're ratioing, right, at 1% or above. If, for example, your ratio is under that 1%, that 75% now goes down to 70%. And so now, instead of getting $225,000 now you're looking at the max that you'll be able to get out is $210,000, right? And so, yes, you still have this equity here, right, of $90,000. That's $90,000 in equity. If you were to sell, you'll be able to recoup that cost. But if you're trying to pull money out, this is the value. This would be around your loan amount. So it's just something that you need to really just keep in mind whenever you are doing a refinance, that a lot of things play as a factor. Your credit, how much you are able to rent the property out for. Is it a season where lenders are giving up to 80% of the ARV? If that's the case, then that bodes well for you if you're wanting to pull out equity. And then understanding your payoff amount. If all those things line up well, then doing a cash out refinance will bode well for you. So hope you enjoyed this episode. I hope you learned a lot. If you do have any questions, please leave it down in the comment section below, and I'll do my best to answer you.